right, so we're looking at the 7 goals that an economy could choose in terms of its top economic priorities. We looked at improved standard of living, right? How do we measure that? GNI per capita, Human Development Index. It's your access to goods and services that make your life better. Economic growth, how do we measure that? That is real GDP per capita. Okay, what about full employment? We look at the unemployment rate, right? Full employment is an unemployment rate between 4 and 6.4%. Stable prices, how do we measure that? That's the inflation rate, and we try to keep it between 1 and 3%. So that puts us now at the balance of international trade. When we talk about the balance of international trade, we are looking at exports and imports. So when we talk about exports, exports are when goods and services, and we'll look at it from the perspective of Canada, are made in Canada and sold to other countries. So exports are goods and services made here and they go out of our country. Whereas imports, that's where the goods and services are made in other countries and brought. All right, what's going on here? Into Canada. So with imports, we are making the goods and with imports, other countries are making the goods and services, and then we're bringing them in. So we have imports and we have exports. So with exports, the goods and services are made here, they go to other countries, which means the money is coming into us. With imports, we are buying goods and services from other countries, so the money is going out. Which means when we look at the balance of international trade, we need to know what's the difference between a trade surplus and a trade deficit. When we talk about a surplus, we're talking about money and we're talking about where the money is. So a trade surplus for us means we have more money that we're bringing in than money going out. So a trade surplus, the exports are more than the imports, because we're selling more goods to other countries, so we're bringing the money in, then we're buying from other countries and the money is going out. So a trade surplus, the net gain is ours, the money is coming in. A trade deficit, there's more money leaving the country than coming in because we're buying more foreign goods than they're buying from us. So the exports are less than the imports. So which would we rather have? Well, you'd rather have your money going out to someone else or the money coming into you. So we want a trade surplus. That'll help our economy grow because money is coming in to buy our goods and services. So when we measure the size of the economy, we actually look at exports minus imports as part of that calculation to determine if there's extra money coming in from the rest of the world. So we need to look at our balance of trade and where we stand. Do we have more money coming in or more money going out? Well, what are those things that are coming in and going out? On the left, you can see imports. Those are the goods coming into Canada. And so the number one thing we import are consumer goods, followed by electronic parts and equipment, and then 3 are cars and automobile parts. Notice with the exports, those are goods that are leaving our country. The number 1 is automotive products, and the second is consumer goods. You'll notice with these two lists, there's a lot of the same thing on both of them. That's because when you make a car, for example, it crosses the border multiple times before it's finished. So parts of the car will come from the US, then they may be assembled in Canada. It really depends on the model because there's also models that the parts come from Canada and the car is actually assembled in the US. So for example, the Toyota Matrix and Corolla are made in Canada. The Toyota Tundra and Camry are made in the US. It's all the same company, and it's importing and exporting. And so it really is specializing in different locations. Often that has to do with who's buying most of that particular model. But the materials that go in the product come from other countries. And in fact, a single vehicle in North America when you consider all the different parts and the assembly and the sub-assemblies, a single vehicle may cross the borders between Mexico, Canada, and the US 1,000 times before it gets sold because of all the parts and how they're moving around. So who do we buy most of our goods from? Okay, that is, who are our primary countries that we import from? Okay, well, you can't see my graph, so it's kind of hard to answer that question if you can't see the information. Let's try reopening this here and see if we can't get our graphs back. So bear with me a moment and we'll see if we can't get our graphs to appear. There we go. So who do we import most of our goods from? Well, it's not China, it's actually the United States. So we import most of our goods from the US at 61.5%. Now it's important to note that the US might import those goods from somewhere else first, and we are simply tracking the country that it arrives from. So our primary country that we import goods from is the US. Who do we sell most of our goods to? Well, 69% of the goods that we sell to other countries go to the US. And then you can see the other top countries are minuscule in comparison. Germany at just over 1%, South Korea, Mexico as well, China at 6%, and the United Kingdom at 4.8%. So there's a big difference between our number one trading partner, the US, for both imports and exports, than our other trading partners. So we are so closely intertwined with the US because of this trade. We do a lot of business with them, which is why when their economy grows, our economy tends to grow. When their economy shrinks, ours does as well. So we really have to be cognizant of that. It's also why tariffs and issues with trade are a big deal for Canada. So perhaps you've seen in the news over the last couple of years issues with tariffs and trade deals, aluminum, steel, right, have become big issues between the US and Canada over, are we being fair? Are we subsidizing and making the prices lower than the domestic market can compete with? And we'll look more at that in this course as we talk about exchange rates, but also if you take my micro course, we'll look into that as well. All right, so we want a balance of international trade. How do we get it? Well, we need to adjust the imports or the exports. So we need to find more trading partners and export more, or we need to change the amount that our people within Canada are buying from other countries. Now, it's important to recognize that what is happening with our balance of trade will affect interest rates and will impact exchange rates. So let's take a look at each one of these. Okay. So when we talk about imports and exports, of course, we are trading with other countries who have other currencies. And right now, for example, $1 US is equal to $1.31 Canadian. So when Americans want to buy stuff from us, their dollar essentially will buy $1.31 of Canadian goods. We can convert that into how much a Canadian dollar buys, 1 Canadian dollar equals, by taking 1 divided by that number. And we do that, we get 0.76 US dollars. So right now, if you were to go to the US, your Canadian dollar is worth 76 cents US. All right, well, does it matter if we have a trade surplus or a deficit? Well, what if we import more than we export? So what if we have a trade deficit? Exports are less than imports. Where's the money going? Right? The money's going out, which means the rest of the world now has our money. And if the rest of the world has our money, what are they going to do about it? Well, they have a couple options, right? They can buy more of our stuff. They can invest in our stock market. So when there's a trade deficit and the rest of the world has our money, if we look at demand for Canadian dollars, supply of Canadian dollars. So just like we can do demand and supply for every other product, we can do demand and supply here for Canadian dollars. If there's a trade deficit, then that means there's now a huge supply of Canadian dollars out in the rest of the world. That big supply of Canadian dollars out in the rest of the world, right? They all have our Canadian money. And that's going to put downward pressure on the Canadian dollar. It's worth less when everybody has lots of it. So trade deficits will cause the Canadian dollar to depreciate or fall in value. Okay. It'll also impact interest rates because if other countries have all of our money, they can either buy more of our stuff or they can invest in our stock market. So when there's a trade deficit, they can now invest more in Canada because they're flush with our cash. And that means that now there's a lot of people willing at least to lend to Canadians or, willing to buy your stocks in Canada. So it's easy to get funding in cash, right? The rest of the world wants to put their money in Canada because they're holding all these Canadian dollars. And they're either going to buy Canadian stuff with it or they're going to invest in Canada with it. Well, if it's easy to get access to money because foreigners want to invest, they want to buy your stocks, they want to lend you money, then what that does is it means that interest rates will go down. So there's this relationship between what's happening with the balance of trade and what happens with the rate of return on stocks and bonds and investments. It also impacts the exchange rate. Okay. We'll dive into this in more detail later this semester. Where do we stand? We said we primarily trade with the US on exports and imports. We've looked here at the value of the Canadian dollar relative to the US. But what do we have? Do we have a trade surplus or a trade deficit? Well, the blue is imports, the red is exports. So you can see for the longest time, from the 80s until 2010-ish, we primarily had a trade surplus. Let's change colors here. X greater than IM, trade surplus. Over the last period of time, though, we've really wobbled right around being exports equal to imports, exports being slightly more, imports being slightly more, and so it's not as clear what's been happening. And in fact, in July of 2020, what we have is negative 2.2 billion when it comes to our balance of trade. So what this means is we have a trade deficit. So right now, there are exports less than imports, right? So what's been happening? Well, oil prices are low, and one of our primary exports, it's actually fallen. So if we go back to this list here, it used to be the exports, the energy products was like number one, number two. And as we look at 2020, it's fallen to 5th place because oil prices have fallen. So the value of what we're selling is less. There's less people who want to buy oil from us because there's more countries making their own. And that is actually impacting our balance of trade. Because as we sell less oil to other countries, then that exports has fallen, but the amount of goods we're buying from other countries is the same or more. So we've switched from a trade surplus to a trade deficit. And of course, the risk with that, with a trade deficit, as we said before, is it puts downward pressure on the Canadian dollar, okay, making that 76 fall or stay low. Ideally, exchange rates, we like to have it 1 Canadian dollar is about 90 cents US. But what we have is a trade deficit pushing the value of that Canadian dollar lower and keeping it down around 75, 76 cents. We also have this downward pressure on interest rates because of these trade deficits. The interest rates have been fairly low for the last period of time. You can see the balance of trade a little bit better. This graph showed you exports versus imports. This one shows you the overall balance of trade. So again, you can see, for a long time we had a trade surplus and then a lot more trade deficits over the last decade. If we compare that If we compare our exports to other countries, you can see that we are in 11th place in terms of the amount of goods we export, and this is in 2017. We've probably fallen even further down because oil prices hadn't fallen as much as they have now. So we're probably even lower on the list in 2019, 2020. You can see here Canada is the top exporter, and this was quite a quick sudden rise to the top. In fact, in 2009, they moved to first place, seeing a 17% in exports just in 1 month. And so China is the global leader in exports, right? We all buy things that come from China. But surprisingly, even though they're the top exporter in the world, they are not the top country that we bring goods and services in from.